G'day Gain Squad. Let's start with a reality check. They say the market is a mechanism for transferring wealth from the impatient to the patient. If you want to be on the right side of that transfer, stick around. Many days have passed, and gold prices are still trapped in a suffocatingly narrow range. However, the more anxious the market becomes, the easier it is to hide the cognitive traps carefully set by big money right before central bank super week. While the price on the screen is still locked in a back-and-forth tug-of-war, a high-level meeting inside the White House regarding the Middle East has already fundamentally shifted the nature of this game. Facing Iran's tough bargaining chips, Trump did not flip the table as many expected. Instead, he showed subtle signs of preparing a counter-proposal. At the same time, a new report from legendary investor Ray Dalio has boosted the recommended allocation of gold to an unprecedented 15%. Before breaking down these heavy signals, we must clarify a deadly blind spot in the market. In this extreme environment where geopolitical conflict and Fed policy are clashing, the trading philosophy followed by countless investors, timing is the true driver of productivity, is now more important than any macro card, even above all else. Hello everyone, welcome to Goldie Gains. Every day, we bring you the sharpest and deepest financial perspectives to help you see clearly through the fog of capital and stay steadier and further ahead than others. Let's go back to the ultimate cliffhanger that will decide the market direction for the next few weeks: Trump's real attitude toward Iran's proposal. Latest international news shows a fierce cognitive struggle within the White House over Iran's condition of ceasefire first, then negotiate the strait. Secretary of State Rubio is playing the bad cop in public, claiming they will never tolerate Iran controlling the strait. But pay attention to a crucial detail. US media reports that while Trump expressed doubt and dissatisfaction, he did not flatly refuse. In game theory, if one side truly has an overwhelming advantage, they don't need to hold meetings to discuss an unsatisfactory proposal from the opponent. The fact that Trump gathered senior advisors to discuss a counter-proposal actually confirms the three weak spots we mentioned in yesterday's video: extreme heat, a weak hand in the diplomatic struggle, and the pressure of the upcoming midterm elections. This has robbed the White House of the capital to start a direct conflict. This so-called counter-proposal is essentially Trump looking for a dignified way out. To lower oil prices before the May US travel season and to protect voters' wallets before the election, he has to back down and use long negotiations to trade for a phased opening of the strait. This leads to a very strange short-term logic. If the US and Iran reach some kind of fragile agreement, crude oil prices will likely see a sharp sell-off. Based on recent linear thinking, if oil rises and inflation expectations heat up, gold feels the pressure. This is why gold prices hit a high and then fell back yesterday, because oil prices stayed strong. But if you blindly short gold because of this short-term logic, you might completely misjudge the opportunity of the century for buying the dip that Dalio mentioned. Regarding gold asset allocation, we already broke down Dalio's core logic in our video on April 24th. In his latest view, this point has been pushed to an even more extreme level. He suggests investors increase their gold allocation to 15%. 15%, that is, a number big enough to shock traditional finance textbooks. Why do I say this? In traditional asset allocation models, like the classic 60-40 stock and bond portfolio, gold is usually seen as just a seasoning to protect against extreme tail risks. Most mainstream institutions suggest an allocation of maybe 1 to 5%. Even for top global institutional investors, gold positions rarely exceed 3%. Jumping from a 5% ceiling straight to 15% is, in the world of institutional trading, the equivalent of declaring the old system broken. It means Dalio no longer sees gold as just a safe haven tool, but as a core position that can stand toe-to-toe with US Treasuries. Why is he giving such aggressive guidance? Because he sees that the US economy has fallen into a very dark trap: stagflation. In Dalio's view, the US is currently in a no-win cycle where it cannot cut rates. If they cut, inflation will instantly spiral out of control due to currency devaluation and supply chain breaks. If they don't cut, high interest expenses will crush the federal budget. When US Treasury credit can no longer provide a safe haven for global assets, the identity of gold undergoes a fundamental shift. It is no longer just a safe haven asset. It is returning to its oldest identity, the reserve currency. This is why even if oil prices drop due to easing tensions, the downside for gold will be extremely limited. Because the drop in oil is just the geopolitical premium being squeezed out, while the rise in gold is the rebuilding of currency credit. Dalio's 15% rule is actually a bottom fishing guide for all professional investors. This means while the market is still stressing over short-term bad news or panicking over falling oil, you should firmly complete your core position based on long-term currency logic. Now that we've covered the macro strategy, we must look back at the cold reality of the trading screen. Why, at a time when Dalio is shouting to buy and the Middle East deadlock is about to break, must we take timing so seriously as the primary driver of productivity? Because in the real world of capital, there is a brutal rule. Being right about the macro direction only gets you a seat at the table, but only hitting the right trading rhythm lets you actually walk away with the profit. During extreme macro shifts, the market is best at one thing. Before proving the underlying logic is right, it uses violent volatility to wash out the shaky hands. I'm sure many of you watching have felt this deeply. Imagine if the US and Iran reach a phased compromise, oil prices drop instantly, and Wall Street's algorithms start selling gold based on cooling inflation commands. At that point, a very sharp short-term drop will likely appear on the screen. If you don't have a sense of rhythm, what will you face? Those who chase the high with big positions will have their mental defense crushed by the drop, possibly triggering forced liquidations and failing right before the dawn. Those waiting on the sidelines will see the big drop and feel extreme panic, losing the courage to buy cheap shares at the bottom, thus missing out on the historic 15% building phase Dalio mentioned. To help you feel this destructive power more clearly, let's go back to March 2020, during the early days of the global pandemic outbreak, to see a tragic history of real trading. At that time, the pandemic was out of control and the stock market was crashing. Every trader with basic financial knowledge correctly predicted the macro situation. A global crisis is here, the Fed will print money like crazy, and gold as the safe haven king will skyrocket. So, some people used high leverage to go long on gold near $1,700. The macro logic was perfect, right? But what happened next was incredibly cold. As global panic peaked, a terrifying phenomenon appeared in the financial markets, a liquidity black hole. Large Wall Street firms, needing to fill margin gaps from the stock market crash, were forced to sell their most liquid assets, which meant gold. As a result, in just 2 weeks of the worst crisis, gold didn't rise. It crashed violently all the way down to around $1,450. Those who were long with big positions and no backup plan couldn't handle that kind of pressure. In the darkest liquidity squeeze before the dawn, they were forced closed and kicked out of the market. What was the final result? After the Fed announced unlimited QE, gold finished its shakeout and shot up, never looking back until it hit a record high of $2,075. But the pioneers who saw the crisis first were completely broke the night before the real bull run started. This history leaves a very deep lesson. They understood the crisis, but died because of the timing. With all the noise hitting us during this central bank super week, keeping your rhythm isn't just a catchy slogan. It's actually the most important skill you can have to protect your money and grow your account in a crazy market. Specifically, this sense of rhythm involves 3 types of extreme restraint. First, restraint in position sizing. In this volatile cycle, never fire all your bullets at once. You must be like a veteran hunter, buying in batches to pick up those cheap shares being dumped by panicking short-term traders. Second, detaching from emotional cycles. When the screen shows a sharp pullback due to peace talks, don't panic. Clearly realize that this is just the geopolitical premium being squeezed out of oil, which removes short-term speculative bubbles and makes gold's credit currency identity even purer. Third, aligning with the right time frame. Do not use the tiny ups and downs on a 1-hour chart to measure Dalio's macro logic, which is based on years. If you look at the long term and understand the power struggle between nations, you won't care about the bumps in the road. With this strong sense of rhythm, any gold price spike caused by a drop in oil is no longer a guess, but a perfect gift handed to the market by big money. Now, let's look at the 4-hour gold chart. Some might ask why I've switched to the 4-hour chart lately when I usually focus on longer cycles. It's because when macro logic is about to hit a tipping point, small timeframe charts give us an early look at the real footprints left by big money. Look at the current 4-hour chart. Gold hasn't broken the recent downward channel yet, and short-term moving averages are in a bearish alignment, meaning the market is still on the defensive. The core short-term support is in the 4660 to 4650 area. While there is some buying power there, a break on high volume would likely lead back to the 4600 level. From a harmonic trading view, the bullish shark pattern we discussed is still forming and hasn't been broken. Current price swings can be seen as the final bottoming out before the pattern is confirmed. The upper edge of the downward channel is currently at 4,700. If gold breaks this resistance with volume, the bullish shark is officially born. This would mark the end of the recent downtrend and could even be the signal for a full reversal. However, if the price fails to break the upper channel multiple times and the shark pattern fails, a move down to 4,600 or even 4,550 to find strong support becomes very likely. Faced with these precise technical coordinates, we must repeat. Seeing the price level is just the start of the trade, but hitting the right rhythm is where the profit is. Right now, as bulls and bears battle it out, the market is full of logic but short on discipline. So many traders get the big picture right, but still end up losing money because they ignore the rhythm. If you go all in just because the theory sounds good, a quick shakeout will wreck your account and your head. But if you panic sell at key support, you're going to miss the boat right when the market starts to bounce. A sense of rhythm means keeping professional restraint before technical signals are confirmed, and using logic to ignore visual volatility when market sentiment is most confused. This deep understanding of rhythm applies not just to the K-lines on a chart, but also to how we judge complex macro variables. Only when we stop being fooled by short-term bad news can we see the direction the big gears are turning. This leads to our last core logic for today. Why do we dare to say the risk of falling oil is actually a great reason to be long gold for the long term? This involves a very high-level financial logic. When oil prices stay high, global inflation pressure is high, but the Fed also has an excuse to keep interest rates high. High rates put pressure on gold. But if oil drops because of peace talks, inflation data might look better on the surface, but the true internal weakness of the US economy, the stagnation part Dalio mentioned, will be fully exposed. At that point, the Fed will lose its last excuse for keeping rates high. Once the Fed has to consider easing because the economy is stuck, gold will hit a perfect storm for buyers. The geopolitical risk hasn't gone away, but currency value will explode because of rate cut expectations. So, we need to think in reverse. A drop in oil is actually cleaning out the unstable inflation-driven noise from gold, leaving behind the much stronger credit-driven power. It is the perfect purifier for a gold bull market. In this super week full of variables, at this moment where the US-Iran game is entering the final bidding stage, every trader is going through a test of both knowledge and mindset. We not only have to face complex technical charts, but also see through Trump's unpredictable diplomacy and understand Dalio's loud 15% warning. But remember, the capital market never rewards the person who runs the fastest. It rewards those who can see the path in a storm and maintain a steady pace. Do not feel hopeless or hyper over short-term swings, because once the big gears start turning, short-term noise cannot stop the trend. Mastering the rhythm is your anchor in the middle of these stormy waves. Of course, at the end of the show, I must seriously remind everyone, all the deep analysis, data, and logic provided by me are just observations and sharing based on market info. This is absolutely not financial or trading advice. The market has risks, and investing requires caution. Everyone's capital, risk tolerance, and time horizon are different. When making any real money decisions, you must think for yourself and take full responsibility for your trades and your life. If you feel this video helped clear up the market's complexity and helped you see the breakthrough point for gold and the potential for wealth redistribution, please give us a like, subscribe, and turn on the bell so you don't miss any deep dives. Feel free to share this video with friends who are interested in investing or feeling anxious about the current market. Every bit of support is what keeps Goldie Gains providing the toughest core financial logic. This is Goldie Gains, and I am your host. Keep your positions tight and keep those gains golden. I'll see you at the next close. Cheers.